the start of each new year, one of the things we love doing is a bit of a deep dive into the 18.6-year real estate cycle, just to get our finger on the pulse and get a bit of an understanding as to what the year ahead may look like. Obviously, when you look out there in the media at the moment, there is a lot of bullish approaches in terms of property markets, stock markets, and 2026 is shaping up to be an incredible year. But I think it's important to have a look at what the other side is saying, what Phil Anderson and Akil Patel and Fred Harrison and some of these people that have a different perspective on the economy and how it works and what is actually to come. So today I'm going to interview Ben to do a real deep dive into the cycle, where we are here in 2026, what the year ahead could potentially look like based on the information that we have at the moment. So before getting stuck in, let's go through a quick refresher of the cycle and the different stages and where we're at the moment.
So one of the greatest books I read a couple of times in 2025 is The Secret Wealth Advantage by Akil Patel. Now, Akil and the great Phil Anderson are colleagues, business partners, and really, really good friends. And this work really came off the back of Phil Anderson's labour of love, you might call it, which is The Secret Wealth Advantage, one of the best-selling finance books now of all time, which is quite incredible. But basically a really deep dive into the American property market, stock markets, and the booms and busts over there over about a 200-year period. Now, both of their work was framed from the great Fred Harrison, who wrote The Power and the Land, as well as Boom Bust, which were two books which effectively identified the two last GFCs that we went through years and years before they happened. Now, what's really, really important is on page 23 of this book, The Secret Wealth Advantage, it gives a really, really good snapshot into the 18-year roadmap. Now, effectively, it's broken into four key parts of the cycle. Effectively, we come out of a GFC style event and we go through a recovery phase. Now, that phase generally lasts for about 6 to 7 years, and that phase is characterized by the wash-through effects of a GFC, so still some fairly negative sentiment, but the world getting back on its feet. So the biggest cities around the world crank first, stock markets begin to rally and recover, and higher quality property in the highest quality markets around the world begins a good recovery phase.
Now, the interesting thing about this work is it's all based on the United States. Obviously, that's the largest economy in the world and has been for quite some time now. So they use that as sort of the benchmark because there's just so much data. But we try and relate it to our economy here in Australia and obviously the Australian property market more specifically, because that's what we care about, that's what we're following, that's what we're investing in. And so if we look at that previous cycle, the very beginning, the recovery, it was essentially in 2012. And back in those years, if you can remember, if you're investing back then, I know you bought your first property in 2011, it was really Sydney and Melbourne that were leading the charge. So once again, just reiterating the fact that those biggest markets generally lead the economy out of the recession and into the recovery.
Now, the second phase that we go through is called the mid-cycle or the recession phase. Now, this period normally lasts for about 1 to 2 years. The last time we went through this was during COVID. It's also been the dot-com boom and bust in the past, the 1980s recession we had to have, the Cuban Missile Crisis. So there's actually been about 13 of these sorts of events recorded in these books, which gives us a good roadmap for how long they last. Now, effectively, after going through COVID, you could see stock markets during this time go down a little bit by as much as sort of 25 to maybe 40%. Property prices in some markets can come down as much as 5 to 10% during that time. But generally, because we've already had the big wiping GFC style event, governments pull some of those levers that Ray Dalio talks about in big debt crises, which is effectively reducing interest rates, pumping money into the economy, allowing banks to start doing some irresponsible lending, some lending again. And then we kick off phase 3, which is called the boom phase. Now, the land boom phase effectively has it has more than 2 parts in this book, but let's just call it 2 parts. It has the steady sort of increase outside of that COVID-style mid-cycle environment that we've talked about. And then it has sort of a mania crazy phase at the end, which Phil calls the winner's curse. Now, again, This phase lasts for about 6 to 7 years. And what have you sort of noticed from COVID until now around the Australian property markets?
Well, just like they predicted, it starts to ripple into the rest of the country or the rest of the world, essentially, where you'll see Sydney and Melbourne start to slow down a little bit, which has happened in comparison to what we've seen in Brisbane and Perth and Adelaide and a lot of the regional markets around there as well. And generally, there's a huge infrastructure boom as well. So people are building lots of things, whether that be roads, trains, buildings, stadiums. The world's biggest buildings all get announced at this stage as well, and do generally start construction during that land boom. And so what that generally results in is the mining sector really starting to pick off, because they're, pulling the natural resources out of the ground and then, doing whatever they need to do, shipping them overseas or refining them here to turn it into the materials required to build those infrastructure projects. So with that, you see those towns that surround the mining industry really perform quite well. We've seen that in the likes of Gladstone, Rockhampton, Townsville. You're seeing it over in Western Australia, Karratha. Those types of markets have absolutely had a tear in this cycle, and that was the exact same in the previous cycle in the 2000s, the mid to late 2000s. We saw all of those markets have a really strong rally as well.
And so we get to this point where a lot of the markets around the country are very, very well priced. For example, the likes of Brisbane, Perth and Adelaide, as Simon said, have probably almost done 100 to even 130% growth in the last 10 years, so in this second half of the cycle. And we get to a peak. And then for anyone that's seen something like The Big Short, where we get to a point and there's some destabilizing, crazy event, which is always different and extremely difficult to predict and see. And then we go the other way in a pretty negative way. So the fourth phase is the crisis phase. That's broken into a whole bunch of pieces. Generally, the worst of it lasts about 2 years on the way down. And then there's this like sweeping up the streets kind of thing, which occurs for another couple of years. But I remember going around Sydney, Wollongong, Central Coast, Newcastle every weekend in 2011 as a 24, 25-year-old when I bought my first 2 properties down there. And for that 9-month period, I didn't see a single investor at an open home. I didn't see a single mum and dad at one. Everybody that I was talking to was like, what are you doing? This is absolutely crazy. Because I'd just finished university and I'd been on Centrelink during the GFC, I honestly didn't even know that we were in one. Until in my first year with IBM in their graduate program, they sacked 200,000 staff in 2011, which was obviously so significant just for that one company to do. So this period can be pretty rough. Like it can feel very, very emotional, and I'll get into all of that in a moment. But it can also have a pretty big impact, like 50% reduction in stock prices. American property prices during this particular period have generally dropped about 35% based on history. So they're the 4 big parts. Once we get through that, which we've gone through this many times before, the Great Depression was another example of this, but it's got heaps of different names in the last couple of 100 years. We get another full run. So there's different things that we can do as investors and as mums and dads throughout different parts of this cycle to take advantage of it and also to protect ourselves. And that is the big reason Simon and I wanted to do this video today, just to make sure that everybody's aware of where we're at. And you don't just go rushing out and buying the market that's already cranked in 2026, but you actually make the best possible decision that you can. And so leading into that, Simon, obviously one of the big things we wanted to do is kind of bring a few ideas or some forecasts into 2026. What are the likes of SQM saying in their boom bust report for the year?
So SQM's come out with some pretty bullish expectations, as has Domain, realestate.com, CBA, KPMG. You can get all this for free online. Just Google Australian Property 2026 and you can dive into it for yourself. But the boom bust bulletin is, the boom bust report is a paid report that you can look at, hundreds of pages that kind of dissect the Australian property market in so much detail. It's wild. I love reading it every single year. So thank you so much to Lewis, Christopher and the crew over there that brings that to us every year. But yeah, Perth expected to continue performing well, up between 12 to 16%. Darwin expected to do the same types of growth rates as Perth. And then next up is sort of Brisbane at 10 to 15%, and Adelaide closely following it at 10 to 14%. And then Melbourne, Hobart looking pretty strong, bit of a recovery there after some rough years. So Melbourne up potentially 4 to 7%, Hobart 4 to 7% as well. And then Sydney and Canberra are expected to perform the worst out of all of the capital cities in Australia this year, up 3% to 6% in both of those markets. So worst case 3%, best case 6%. So across the board, we're seeing price growth. Obviously, we know all of these capital cities are not considered equal. All of them are at their own individual stages of their cycle. Plus, there's cycles within those markets as well. You know, I recently did some videos on Sydney, and I was talking about some suburbs around Blacktown that had gone up over 20% in the past 12 months and smashed the averages. Same in Melbourne. You know, the average property went up about 5-6% last year. Some of the suburbs that we were buying for clients down towards that southeast, like Frankston North, up over 20% as well. So there is those needles in the haystack that you can identify if you know where to look, if you know those underlying fundamentals that are going to allow a market to recover a little bit quicker. And then obviously the other parts of the market, like those saturated unit markets or those very expensive blue chip markets, are generally going to struggle at this point in time.
You know, so the most important thing with this stuff is to remember that there is history that we can learn from, and we can make better decisions based on different stages of that history and understanding it. But I think where the rubber really hits the road with this stuff is in real world application. Now, I remember it was about 2017. It was about 2 a.m. in the morning, like I was looking after my kids. My wife was away for the weekend, and I was going super deep down the rabbit hole. Now, by 2017, I'd done a pretty decent number of properties. I couldn't tell you how many, but I think it would have been at least 13, 14 odd property investments during my journey. And I'd made every single mistake that you can imagine with my own money. And what I was looking for was a method to the madness. I'm still not convinced that people go, just buy and hold and it will go up. And I do believe that there's something in that, obviously, for the average investor, but I was looking for cycles. I was looking for people that had analysed hundreds of years of history and come up with some, you know, guardrails effectively so that I could not just bowl, but I could bowl with bumpers on it and make less mistakes. And I found all of Ray Dalio's stuff. And then at the bottom of one of the forums with the Ray Dalio stuff, someone was saying, you've got to check out this book, The Secret Life of Real Estate and Banking. So I bought that book that night. It was the toughest read of my life. And what I'd recommend for everybody who can get your hands on it, because it's really expensive and it's really hard to buy, but it changed my life to the tune of millions of dollars. That's the impact it's had for me and the people that I care about. And I'd just say, first time going through it, go straight to the last chapters where Phil sort of summarizes all of the findings from hundreds of years of history. But effectively, it was the start of me pulling on a cord. And you and I have been pulling on that cord now for almost 8 years straight. So from that book, we then found out that Phil was coming to Brisbane. And as absolute fans, we went and saw him. And then I reached out to him personally because there's handfuls of people that you'll ever come across in an entire lifetime that are as obsessed about the one thing that you're obsessed about as we were. And so I flew down to Melbourne and spent a couple of days with him, and we recorded some videos. And then we started to record videos more regularly together, which was really cool. And then it kind of went to you and I catching up with him in the Goldie and getting to have some beers together, some dinner together, and really sort of going down the rabbit hole. And that relationship with Phil and Akil now over most of the last 7 years has radically changed both mine and Simon's life for the better. His content, if you're not a subscriber to it, is Property Share Market Economics. There's a free newsletter you can get on. There's a paid subscription that we get on. But either way, the real world application of this is 18 months before COVID or the mid-cycle slowdown, the second phase of that 18.6 year cycle. He basically said, this is coming to this month, and this is what I would do to prepare for it.
Wildly accurate as well. I remember vividly having those discussions at the time, and you'd be on a Zoom call with him in our open plan office as well, and he's telling you this stuff. And at the time, the media was obviously the complete opposite. It was just like, avoid everything, bury your head in the sand, don't do nothing. This is the bubble that's going to burst.
Yeah.
And feels like, don't listen to the nonsense, don't listen to the media, trust the cycle, trust the data. It appears to be unfolding the way that it is. And I remember at the time, like, I'd just begun my investment journey. Like, I'd settled on my first investment property at the beginning of 2019, settled on my second in the beginning of 2020, and then settled on my third in the middle of 2020, and then settled on the fourth in the beginning of 2021 as well.
Just
So
pretty scary, right? Like, with the uncertainty of that time, like, because the mid-cycle event always feels quite scary and quite intense.
yeah, and then you get this hindsight now, 5, 6 years later, and you get that positive reinforcement that yes, it does work, which once again becomes that like self-fulfilling prophecy of like, if you're willing to kind of ask the hard questions, like the 2 a.m. diving into the rabbit hole, going head first into this sort of stuff, it's like, if you're willing to do that work, sometimes you get to reap the rewards of it.
So at that point, our mum had about 500 or 600K in super, and we shared this information with our mum, and she actually listened to us, and not us, like Phil and Akil, and she put the stocks into cash. She saved that 35 or 40% drop in the stock market, and then she reinvested that money back in and obviously made those returns. And I kind of went, shit, not only did he sort of predict this, but he told us to the month what was going to happen. He had no idea the event was going to be COVID, but he knew that there'd be a big event that would sort of rattle the system and scare everybody. And then he told us that it would last about 18 months and that things post that, particularly in the Brisbanes, the Perths and the Adelaides, would go absolutely ballistic. Now, it wasn't like we were first-time investors at that point either. Like, by that point, we'd bought hundreds and hundreds of millions of dollars of property for our clients, and we're starting to overlay this bigger picture macro framework with the super specific suburb identification and market identification stuff that we specialize in here at Pumped as buyer's agents. So that relationship has completely changed our life. And what I was hoping to sort of do now is kind of a bit of a book review for exactly where we're at this stage of the cycle.
I love that, because at the end of the day, like, there's two things that matter when it comes to property investing. And first is time in the market. The earlier you can get started, the longer that you can be involved and let compound growth take its effect, the better that you'll be in the future. But then everybody knows the second best thing is timing the market. And if you can, identify the needles in the haystack, the markets that look statistically undervalued, the markets that, based on history, perform well through these phases so that you can succeed and take advantage of these opportunities, it gives us a really clear blueprint as to what's to come. And for me, I think the first step to overcoming any challenges is having that awareness, like not being ignorant to the fact, but actually being honest with yourself and going, there's gaps here and I need to fill those gaps. The first thing is knowledge and awareness. And, this mania phase that we're in right now, there's a lot of things that are happening around the world that are perfectly aligned to where we're at in the cycle. And this is where people do sometimes get caught up with the emotions and make those silly decisions that could cost them time, or more importantly, money as well. So let's dive into it. Like, what has Akil broken down in really simple terms that we should expect to happen over the next 18 months?
So again, this is the Secret Wealth Advantage. This is chapter 12, page 181. And it starts with saying the greatest party on earth. Now, just to reference how intense the 2020s have been, think back to the 1920s and the Great Gatsby era.
I was just thinking Great Gatsby in my mind.
And the 1980s, which was the disco era, where obviously everyone was playing up and there was a lot going on at that time. Now, in both of those times, as of now, there were people that were doing extremely well and there were people doing it extremely tough. Now, my wife and I sat down and did our budget a couple of days ago for this year and just really looked at everything. And I'm like, some of these costs, like I used to have $300 a week for food for a family of 5 with all the pets. Now it's like $600 a week to eat the way we want to live. I used to be able to get away with paying a couple of $100 a quarter in electricity. Now we're talking like $1,000 if I didn't have the solar system I have. But what's important about this phase is just to step back from your own situation and look like macro for a second and go, gold is at all-time highs, silver is at all-time highs, crypto's
A little bit below, but
a little bit below, but it's a fucking hell of a lot up from where it was in 2020.
too right.
If you look at Sydney, Melbourne, Brisbane, Adelaide, Perth, Darwin, Canberra, Hobart, every single one of those markets is now at all-time highs. Everything since the start of the cycle has effectively doubled. And one of the things that we wanted to do after we get through this book review piece is actually go through the insane amount of data that we did together in December with one of our colleagues, Tim, just to show you market by market what's happened full cycle last year, last 10 years, last 7 years, so that you guys can, like us, strategically pull the eyes out of the market. But it starts with the greatest party on earth. And if we have a look at what it says, now this is referring, like in this particular part of the book, to like what happened in Japan in the 1980s. Now, Kill goes on to talk about another one of the headings is the bubble in lending. Now, if we think back over the last sort of 10 years, 2015, 16, 17 was when APRA first started to step in, and we saw some crazy stuff during that period. And then they continued to step in as the banking regulator in Australia throughout 2020 until now. But for those of you who haven't been like really closely connected to the market, the surge in super fund lending, trust lending to individuals, to groups of individuals has been absolutely rampant.
Lower deposits required to get into the market.
Absolutely speculative, unresponsible for the last 2 years in Australia. And thankfully they're starting to get responsible again. But it talks about the bubble in lending and the boom that will never end. Now, this is just to sort of like put it into perspective from the 1980s, something in Japan, right? An enterprising Australian official arranged for sale of half of the land of the Australian Tokyo Embassy for $640 million. With the proceeds, the Australian government was able to reduce its foreign debt by half just from the sale of the land, because prices of land in Japan had gone absolutely off the hook in that.
Hell of a decision, right? Like, obviously those numbers don't seem like much today, but back in the 80s, that's staggering. That is just ridiculous overvaluation of land in Tokyo.
Yeah, so some of the things in this mania phase, which is chapter 12 of the book, is this stage is ignited by changes in banking regulations, leading to a surge in land prices. Now, where in Australia, since COVID, haven't we seen things go absolutely ballistic outside of maybe parts of Melbourne, Geelong, and effectively Sydney? The mania is driven by new lending. So if we think about all of the things that are occurring at the moment with the first home buyers grants, we've done videos on this recently, but what are we talking about? We're talking...
So they've obviously increased the thresholds to allow first home buyers to spend more money. So that's the first thing. It's like these guys can now buy more property, different types of property. They are getting government-backed guarantees, so no more lenders' mortgage insurance, which reduces those barriers to entry. Plus, obviously, you're going into it with the government backing you as well, but it's 5% deposits. So you're at a 95% loan, and you know, if you have a parent that's over the age of 60 and you talk about a 95% loan, they're going to have a heart attack, because like it is just taboo to think that you would loan so much money from the banks to get into property. Like the historical average is 20-30% in most instances. So to be able to get in at such a low deposit is, you know, I guess great for young first home buyers that do have a 20 or 30 year plan to hold that property. But at the same time, there's risks associated with putting such a little cash deposit down on a property.
Then we see a surge in construction, which is occurring across the country right now. The stock market surges as well. And then we start to see the world's largest, tallest, longest, deepest, whatever announced. And we're starting to see, and we have been seeing this since COVID, with a lot of those biggest things. Think Neom, for example.
That's been shut down now.
Yeah, just
mid construction.
what's important is it says announced.
Yeah, that's right.
You know, maybe not delivered on, but announced. And I think that's really important because it's like, it's just a sign of the time, effectively. Like, land prices have gone up enough, speculative lending is high enough, demand for these things at that time is high enough, and I'm talking in the post-COVID market, that these sorts of crazy things start to happen. We then see inflation and interest rates rise, the yield curve invert, which we saw in 2022 through to parts of 2024, and we start to see popular interest, which is effectively, he's saying your doctor, taxi driver, hairdresser, builder, bank manager are all talking about what they're investing in the property market. Now, what is fucking crazy is this book was written before the last year, but if we think about all of those things, every single one of them is repeating based on history. Now, in this mania phase, it goes on to the prevailing emotion being greed.
Mm-hmm.
I've been feeling this massively. I fucking miss Perth.
Mm-hmm.
I miss Townsville. I miss Darwin. I miss the gold run. I miss the crypto run. And I knew I should have bought silver at $32 and now it's trading at 80. So it's greed. Like,
Yeah.
I've been looking at selling properties to move into things like silver recently, which is, I've been investing in property for 16 years. I've been following silver for about 3. I've just been like sucked into it, and I like have read this book front cover to back cover twice. I've read Phil's book front cover to back cover twice. I've got these guys physically in my life, the authors of these books, telling me not to do this silly stuff, and I'm still being sucked in. And I'm sure you've been feeling that. Everyone's got to be feeling this. Like, their mates just made up 100K in crypto. I didn't make it. I want to make it.
One of the most common challenges that people face at the moment when I ask this question in a strategy session is FOMO, fear of missing out. You know, people are hearing all of these stories, their colleagues, their friends, their family members, whoever it may be, of these success stories, and they've made so much money, and then, you know, they get this fear of missing out. They're like, I need to make up for lost time, and this is where people make those risky decisions. And what I love is crypto, in the sense that this is a new, I guess, asset, investment, gambling mechanism, whatever you want to call it, but it's got such a short-term cycle, and you can see how that can be relayed to stocks or to commodities or to real estate that have much longer cycles than crypto does. But everyone talks about the emotions and the decisions that people are making at different stages through this crypto cycle, which kind of gives you a bit of an indication as to what it's like for everything else. And it's absolutely that way at the moment. I've been feeling it. A lot of people, a lot of investors that we've been talking with have been feeling it. And it gets people caught up on the wrong information. They want to back that winner that's already doubled in value over the last 5 or 6 or 7 years, thinking that the next 5 or 6 or 7 years is going to look the same as what we've seen in the short-term past.
I'm really glad that you said that, because this is the Handbook of Wealth Secrets, he calls it part 12. And the title is Do Not Follow the Herd, It's Time to Rein Back. Now, what we're talking about here is, or what he's talking about is being selective with property investing, which we've been talking about for years and years and years now. There is no Australian market, and there's actually no Sydney or Melbourne market. Sydney is about 6 markets, as is Melbourne, and then there's the major regional centres around that, which there's a big difference between Caloundra on the Sunshine Coast and Noosa on the Sunshine Coast in terms of valuations and cycles and where things are at. And I think it's really, really important, particularly for 2026 forward, to pick the eyes out of the markets that haven't cranked in the last 5, 7 or 10 years, because if you don't, you can get burnt really bad, and I'll go into that in a moment. The other thing that he said is buy commodities, including gold and silver. Business owners, he says it's time to exit or reduce your risk. So there's a lot of business owners out there that listen to this, that are sitting on pretty significant debts to banks and things like that. Like, there's a lot of businesses our friends own that are fully based on bank-backed loans. So it's just important. And it also talks about reducing costs or reducing borrowing if possible, building a pool of safe, liquid assets, and disposing of weaker assets to realize profit so that you can redeploy when the opportunity comes. So everything I'm hearing there in terms of what he's saying is a call to safety and to conservatism, which is where we are at the moment, versus a call which is the exact opposite of the FOMO, the greed, the mania, the speculation. And last time I spoke to Phil, he said, Ben, what we will see from here on out is the real economy going flat or slightly declining, with the artificial economy of stocks, property, crypto, gold, silver, AI effectively moving away from that. The valuations will get significantly more and more and more unusual. And that's why it's so important to understand your history and understand where to buy. And I don't want to come across this year in a negative way because, according to SQM, it's going to crank this year.
Why it matters though is because not all markets are considered equal, and we're going to go into that in a moment and look at the data. But to give everyone a real world example of what this looks like is, fundamentals matter, and that's why we continue to bring those home in almost every single video that we produce these days. But one of our clients, he's based in North Queensland, he works in the mines. He bought his property in, it was, Gladstone or Rockhampton or Mackay, one of those big regional markets up in Queensland, back in sort of 2016, 2017 for about low $400,000. Now, the person that he purchased that property off had bought that property back in about 2011, 2012, the very peak of the mining boom in Australia, for $650,000. So from roughly 2011, 2012 through to like 2017, the value of the property went from $650,000 down to about $350,000, back up to about $400,000. Now, our client that owns that home, he said that the property's now doubled again. It's now worth $800,000. But these markets that are so tied to the cycle and are very speculative and volatile because they don't have the underlying fundamentals. They don't have the economic diversity. They don't have the population or the population growth. They don't have the infrastructure. And when things get tough in these small towns, people generally retreat back to where they can maybe get a better paying job. And that might be in a Melbourne or a Sydney, where you've got limitless employment opportunities because of how diverse those economies are. So, my belief is that these small regional towns are getting to a point that, look extremely risky, whereas, markets like Melbourne, like Sydney, if you're planning to hold the property for the next 10 plus years, look incredible. And that's just based on history and what's occurred in the last 5, 6, 7 years since the Royal Banking Commission and throughout the COVID boom, and also relaying it to this 18.6 year real estate cycle and how that has historically influenced Australian property prices, because that's what we're producing this stuff for, right? It's about the Australian property market.
Yeah, like all we're doing this stuff for, like the reason I'm reading it, the reason I'm reviewing the market is so that we can help ourselves, our families and our friends make the best decisions possible. And we can help those 3, sometimes 4 new investors that we choose to take on every single week to make the best possible decision. Buying is what every BA or buyer's agent in Australia does. Generally in the markets that are closest to their home, that they know the best. But if you go, well, let's not just take let's buy and let's hope and let's go that's good enough approach. Let's look at the entire basket of goods and find the needles. And then within the haystack, let's find the opportunity that is the one, based on history, based on current market timing, based on fundamentals, and based on what nobody is seeing when they're rushing over here doing this thing.
And it's so important to have that team of advisors as well, because at the end of the year last year, I was looking at that property and I got so emotional about it. I'm like, oh, this is so cheap. It's got a good rental yield. Like, it's got development potential. And, I basically gone, I'm going for it. I'm in. I'm buying. And I got the offer form from the agent and things like that. And before I do anything, I always check in with you and the team and just say, hey, like, am I doing something silly? And you looked at it and we looked at the recent sales history around it. And you're just like, look, Simon, hey, it's your decision. But at the same time, like, does this align with what we do? And it didn't. And so I decided to just go, look, I'm just going to leave it. I'm going to sleep on it, and then ended up sleeping on it for about 16 nights and decided not to go for it, because your advice was you could go for that property and it may work out, but if you were to spend an extra $50,000 or $100,000, you'd be able to get a freestanding house in the same suburb. And we know based on history that freestanding house is going to dramatically outperform the duplex that's got a shared wall. And so, you know, sometimes slowing down to speed up, or maybe even spending that little bit of extra money to get into the higher quality asset, the higher quality location, ends up paying dividends over the long term. So, you know, no matter how much experience you've got, it's so important to just have that team around you that can, you know, just sanity check anything that you're about to do, because spending $600,000, $700,000, $800,000 on a property is not a small decision.
You know, I love that you brought that up, because I've consulted you so many times in the past, like where I've gone to buy properties and you've been like, no, flat up no, and it's like, cool, like, you know, spiritually it's like consult many people and you'll make better decisions with your life. But recently, on the flip side of that as well, I had $500,000 in my self-managed super fund, and I'd organised with the I'd organised to buy some silver. I was going to literally have a big punt. So I was talking to many different people about my decision with that, and getting their feedback and the pros and cons of that decision. They didn't know that I'd been looking at that asset class for over 3 years and looking at the history. And this was when it was $32. And I consulted people who they didn't have the time sunk into learning about it that I did. They didn't have the knowledge of the cycle. They hadn't read these books. And I listened to them, and I didn't make that decision. And now that 500K would be worth over 1.2 mil. So I think it's important to consult your team of advisors like Simon and I do on all decisions. But it's important to remember that when you become obsessed with just one thing for a long-term period of time, you may see opportunity where other people see fear. Because all of those people couldn't see themselves making that decision from where they were, and they overlaid their stuff onto me, and that decision cost me $700K in under 5 months. And so I think it's really important. The thing that I learned in 2025 is consult your team, but specialize in and niche in on what really you understand. If you're a crypto person, become obsessed with it. If you're a property person like Simon and I, become obsessed with it. And you can't learn all of Australia, but you can learn the history of Australia, and you can learn what's next, and then you can become obsessed with one suburb. If you're like really into silver or gold, go all in on that one thing. But I won't be seeking people who are not where I want to be, or not specialists in the asset class that I'm considering anymore. Because it can cost you on the flip side massively.
What was the term that Akil used in the mania phase about the people that are going to be talking about this stuff? The barber, the
hairdresser.
What was that particular term? And that's what it's talking about. It's like, don't take the advice of the person at the barbecue or at the smoko lunch break or wherever it is. It's like, look to the people who have got the experience, that have got the track record, that have the expert knowledge, that have gone down the rabbit hole so deep that they have the conviction and they have the knowledge to actually give you the advice that you need to make the right decision. So it's such an important aspect, because of where we are in the cycle, to just be mindful of who you're getting your advice from.
Without a doubt. So I'm going to skip chapter 13 of the book, and now I'm moving to chapter 14, which is called The Summit, from pages 209. Now, it starts with nobody rings a bell at the top of the market. Nobody goes, hey guys, we're here. Simon off camera was telling me a story about someone that he knows who's in the world of banking, who is so bullish and confident about the future. And that is just so common for this particular phase, right? Because from the last GFC, there'd be a lot of people in banking and real estate and stocks still.
High up.
But a lot of the people that are like prepared to work 100 hours a week are in their 20s and 30s. And those are the people out there making the decisions on the floor with the bunny based on other analysts who are, again, looking at everything that they possibly can, and making the best decisions that they can. So it starts with sunny vistas and skyscrapers. Effectively, things look good. Now, I was at Cronulla the other day in Sydney. Everywhere I looked was another like ridiculous apartment blocks going up. And I flew over Sydney, and there are things everywhere. I fly over Brisbane. The biggest everything is being built across Australia right now. I was in Melbourne recently. Stuff was going up everywhere.
Talk about risky lending as well. You know, I was talking to somebody about private equity finance, where on these big developments that you see in Cronulla and Bondi and the Northern Beaches and down in Melbourne, on the Sunshine Coast, Gold Coast, Brisbane, you know, it's happening all over the place. I would love to know how many cranes are up around Australia at the moment, but it'd be
There is a
thousands
crane
and
watch, I'm not
thousands.
sure. I wish we had that dude from some of the other podcasts that just has a look for us.
But these developers seek private equity finance from everyday Aussies like you and me that may have some spare change sitting in an offset account or whatever it may be, and or a term deposit, and they can use that. So let's say it's 100, 200, 500, however much you can afford to put down, and these developers will guarantee a 12+% and above average yield on that money, plus obviously some opportunity for some capital growth on the back end of it over particular periods of time. And when I was hearing these stories, I'm just like, knowing when these projects are expected to come to completion and start being sold to the market, and also looking at like the types of returns that these guys are guaranteeing, it just was alarm bells in my head going off.
Like I walk around places like Bondi or Manly or Cronulla or Noosa or wherever else in Australia, like Geelong, Mornington,
Ocarina.
and it looks like everything to me happens in 20-year blocks. There's like the red brick that we all knew, and then there's like the coloured brick that we all knew, and then there was like the rendered look that we all knew, and then there was like the archways with the like timber on it that we all knew. And it's like land prices have to get to a certain point, and the profit for these developers to go and do it, and the lending to be in alignment with that. And so like once every 20 years, Australia gets washed with these beautiful new projects, and then nothing happens for a period of time post that. So Phil said this years and years and years ago to me when we caught up. At this particular point, the summit, there's this idea that prices will not fall. There's this other idea of the Grand Declaration, which is effectively the person in charge of the Western world coming out and saying, we've solved this. We're in the strongest economy, position, nation, world that we've ever been in, and it's all because of me. Phil said to me, like when we were catching up for lunch, how crazy would it be if Trump got in, then Trump got out, and then leading up into the mania, winner's curse phase, the summit, Trump got in back again as one of the biggest real estate tycoons in American history, and how that would play out. And I can almost guarantee that at some point this year or early next year, we're going to hear everything's sorted. Inflation is under control. Even though we might be cooking the books on it, higher costs are squeezing businesses and households, and spending reduces. As if we're not feeling that right now. As if we're not feeling in our households that there's less money at the end of the month than there was when interest rates were at 2%.
It's bill shock almost every single time they come in these days. It's just like, wait, what?
Yeah.
How is it that expensive?
Yeah. The property market, again, this is at the summit, the property market slows. Central banks try to rein in lending and engineer a soft landing. So there's some stuff that I wrote down here that I just wanted to bring up around exactly this that I've started to notice. So central banks try to reduce lending. We've just heard just before Christmas that they're not, two of the biggest banks, CBA and Macquarie, are no longer doing this dodgy fucking trust stuff that I've been saying for years and years and years is as bad as the lending that we saw in America leading into the last GFC. I also heard something like if it's going from 6 times income to 5 times income, and only 20% of loans would be written to those people. we've begun to hear the 50-year fixed rate loans in America. The UK is already talking about them, and I guarantee that we'll see them in Australia as well.
They're also saying, we were expecting further interest rate cuts, and maybe that's off the table now as well. So trying to keep things where they are so that they can avoid inflation coming back as hard as it potentially could come back as well. Maybe it won't matter based on where we're at.
I mean, the Australian government and the American apparently are already changing the basket of goods to make inflation look lower. I heard in December that inflation in Australia is more like 11% right now.
Feels like it.
They're just sort of... I walk around like Westfield in Sydney or the Sunshine Coast Plaza up here. I've just never seen so much spending on credit in my life. Like, these shopping centres are absolutely bustling right now. So the Handbook of Wealth Secrets, part 14 on page 217, starts with the last moment to sell. It's approximately at the very top, and the prevailing emotion is delusion. This is going to last forever. Fucking dangerous. It gives me goosebumps almost. Stock portfolio, managing investments and tips. Stock portfolio, sell, hedge, or get ready to short. The big short. Secure your property investments, which means what I've just done, interest only, offset accounts, selling underperforming properties that don't have the potential over the next 10 years to outperform other asset classes, setting up things like variation to tax assessments so that you're getting all of your money in on a weekly basis instead of waiting for that balloon at the end of the financial year, changing banks so that you're getting the best interest rates. And some of my clients, for the first time in about 5 years, I'm hearing them start to say, should I fix in 2026, 2027? I don't know.
Yeah. Another one is increase your rents if you have the ability to. Increase the income. So a lot of our clients, we bought properties that do have the capacity for them to build a granny flat in the backyard. There's lots of equity in the properties. You can build a granny flat in Brisbane or Melbourne for $220,000, $230,000 for a state-of-the-art one. In Brisbane, they rent in most suburbs for, minimum $400 up to $600 per week. Down in Melbourne, they rent for between sort of $350 up to maybe $450 per week. So, being able to generate an extra $20,000 to $25,000 per year of income can be a great way to obviously, make it a little bit easier to hold those properties if inflation sticks around, if interest rates do go back up.
Yeah. Continue to hold commodities like gold and silver. Businesses must prepare for the crisis. So that's effectively just understanding your position and, making the most of this. Now, we go into the next phase, which is the fourth phase, and that is the crisis phase effectively. That is the phase where we see the crash and then the rescue recovery. So I didn't want to harp on this too much because we're not there yet. Like, it's really important to note that according to Phil and Akhil's stuff, like, they're saying get prepared, they're saying to do these things, they're very, very clear on where we're at. But we haven't seen the stock market drop 35 to 50% yet. We haven't seen
the yield curve invert.
We haven't seen the biggest open up yet. We haven't seen the leaders of the free world effectively go, this is the best market and it's all because of us yet. But we are starting to see the cracks in the system. So effectively the crash, which is something that's coming and it's important to note. The reason I want to finish this with what we've found from looking at every single major market in the country is there is so much fucking gold in Australian property now. One of the most common things I get on the questions on YouTube is, if you guys know this is coming, why are you still buying? If you know this is coming, how can you sleep at night helping people do this still? You said in 2019, but by the time you got to this point, you guys would just stop doing this work for 2 years until things happened. And that was mine and your position. I legitimately was like, once we've rinsed Adelaide, Brisbane and Perth, I saw no value left in Australia personally, because I just assumed, and assumptions are deadly, that Melbourne and Sydney were cooked, Canberra was cooked, Hobart was cooked, and everything else was cooked. Goldie, Sunny Coast, clearly cooked. And I went, there is an Australian market. It wasn't until I worked with a friend of mine that had been coding in London for the last 20 years to look at the 19 biggest markets and the 4,000 major suburbs within those markets that I went, what's wrong? I actually got him to check the data for us for 4 primary markets, which we'll talk about in a moment, 3 times before I believed him. And then it took me 9 months to go check it myself to make sure he hadn't fucked up again. Because I went, there is a hole there. Then we started to get on H-tag, and the stuff that we've just found in December is out of control.
What's important to recognise about all of this is it's based on the United States. It's based on, yes, the free world, the Western world, but much, much, much larger economies than Australia. And so we are a drop in the ocean in comparison to these guys, and the amount of money that's being transacted here in comparison to over there is just, we don't even get mentioned on the global scale. It's just not even on the global radar. Australia is. So, you've got to be able to understand. This is why having a personal relationship with Phil is so important, because everything that he produces is based on the cycle, which is led by the United States. He very rarely relays it or relates it to the Australian economy, the Australian property market, which, being friends with him, allows you the opportunity to actually ask about where things are at. And then we can look at this data that we've got and make an assumption as to, okay, well, what happened last time? And whilst history doesn't necessarily repeat to the exact same tune, it does repeat in some way, shape or form. And that can help you make some more informed decisions. And when you look at the number of properties that are bought and sold every month, every single year, and the amount of people that are still moving to Australia right now, there's still so much demand, and people are going to do something regardless of whether they know about the cycle or not. We're going to be doing something regardless of what we know or not. And at the end of the day, if you're going to do something, you might as well try your best to do the best. And that's what it's all about. It's like, if you're going to buy a property and hold it for the next 10, 15, 20, 30 years, how can you succeed? How can you get the best possible outcome? How can you put yourself in a position where you don't have to worry about these times when they do present themselves?
One of our friends, Jack, who runs the Entourage, said this morning on his Instagram that there is more business owners in America than Australians in Australia. Just put that in perspective for a second. 27 million business owners. So what happens effectively is there's a trigger event, just like COVID. Now, trigger events can be a whole bunch of different things, like the Cuban Missile Crisis, the dot-com boom bust, 9/11. It could be bank failures in America in the last GFC. It could be the Great Depression. Effectively, it's something that scares the absolute shit out of people. That is horrible. Like, the Lehman Brothers.
Yep. Goldman Sachs.
Just something happens that goes, whoa, that's an institution that just failed.
Yeah, that doesn't happen.
Then people rush to cash. It says liquidity. But people go, shit, freak out.
Sell.
Banks begin to fail. Businesses fail, and we get into economic depression. The market crashes, and then the property market finally comes down after all of that. The crash typically takes 2 years from the summit to the lowest point, as it takes place, adding to the deep distress of the investing public. In every cycle, they succeed in luring away the hard-earned savings of large numbers of people, while the banks get bailed out by the governments around the world.
And there's a great movie about this called Margin Call.
Yeah.
That shows you what a hedge fund does once they can read the writing on the wall and actually know what's going to happen. And, I just highly recommend giving The Big Short and Margin Call a watch to just sort of see what we're referring to here, from the summit to the crash.
So what's interesting is when I talked about Chapter 12 Mania, it was like the prevailing fear was FOMO, greed, everything's going absolutely ballistic, and they said, be sensible. What's interesting here is it starts on part 15, page 230. Stay calm and wait for the low. Stay calm. Phil, the last probably 4 times we've caught up with him, has said, just really get your health together at this phase. Look after yourself, because the managing emotions of the global collective worldwide, people that are 50, 60, 70 don't want to see their self-managed super fund go down 50% like our dad did and our mum did in the last GFC. People don't want to see their properties that have been going up in value now for 14 years straight drop by 20%. Now, what's important about what you said, and I wanted to refer to this, is America has typically dropped by 35% in property and 50% roughly in stocks. 35 to 50%. But in Australia, when we caught up with Phil and the Goldie, I say recently, but it wasn't that recent, he looked at the last 3 real estate cycles, 60 years of data, and he looked at the 14 years up and the 4 down. Now, in the 4 years down, what was interesting is that Sydney and Melbourne averaged 8% down, and not including inflation, so that might be more like 15%. And Brisbane and Perth in those 3 last cycles for those 4 years down, so the GFC and the 2 GFCs before that, averaged 12% down. I can't even fucking buy a property, hold a property and sell a property and pay the tax on it without being 25% down. So what are we talking about here in Australia?
The funny thing is, when you look at the Homely data as well, that looks on the year-on-year median house prices, from 2007 through to the beginning of 2012, Melbourne property prices went up by 44%. Now, there was one bad year, but there was many really good years there as well. And so, you know, I found it really interesting to think that through the mania phase, the summit, the crash, and the rescue, property prices in Melbourne in particular went up by 44%. But if you look at, that's the Melbourne market as an average.
That's
if you look at
Homely, yeah.
If you look at individual local government areas down there, which is what we've done from 2007, you can clearly see that there's some other markets that absolutely smash those numbers. Like that Melton region had 6% average vacancy rates. Like everything was kind of against the norm and what is good investing. But that went up by over 70% over that period of time as well.
As did Geelong, as did Mornington Peninsula. And so this is so important, what you've just touched on. If you pick up the entire basket of goods, then you're going to be scared. If you go, Australia is actually a complex economy with some places winning and losing. And I always went, why does Sydney and Melbourne or New York and LA or London and Tokyo and Beijing crank in the first half? It's because by the time we get there again, Melbourne hasn't done anything in 8 years. Sydney's starting to look, again, like Sydney is extremely unreasonably priced for locals. If you're earning 300k a year as a combined income and the properties around you are 200k, 2 mil, that's caught. You know, but if you're earning 300k a year in Melbourne and the properties around you are 700k, like it is a whole different basket of goods we're talking about here. It says to wait for the lows, short sell weak stocks, manage your property portfolio, continue to hold assets, continue to hold gold, but sell other commodities.
That gets me excited.
It's interesting because silver, right, from the start of the GFC, like the actual start when the market shat itself, took a 50% bath. Then it went up by 480%. Then it went down to 83% of it. Like it went down by 83% after it. And this all happened in a period of like 3 and a bit years.
And the world's not full of dummies, right? Like there is a lot of intelligent people with a lot of experience out there. We talk about these banks and hedge funds and your BlackRocks, your Vanguards, so on and so forth. Like these guys know what they're doing. And the sad reality, and when you watch Margin Call, you get to realize that these big guys, they don't lose.
They had an unfair advantage before they had the smartest mathematicians and AI in the world. Imagine adding AI into this stuff.
It's going to be crazy. But then the unfortunate reality is the buck is passed on to the retail investors, the mums and dads, the average individual that's just trying to get ahead in life. And so it's so volatile at that stage. And, you know, you can absolutely win if you've got the knowledge, the awareness, if you've got the ability to make good, calm decisions at the right time and just avoid getting taken advantage of from these big organizations that have so much access to information and history that they can time it. They know when to sell, they know when to short, they know when to get back in. Like, they know exactly what to do, because you talk about those returns, like avoiding that 50% drop, but then maybe getting back in for the 400% spike. Like, when you're talking about billions or trillions of dollars, it's ridiculous.
You know, the people that win are the people that are obsessed.
Yes.
So every single day, Simon and I get over 60,000 pieces of property data. Click one button and it auto-populates with all of those pieces of information from over 4,000 suburbs on the 19 biggest markets. I was driving for a surf recently with one of my mates. Now, for over 10 years, he's specialised in one thing, Bitcoin. That's it.
Mm-hmm.
That's all he does. That's all he did. He worked with 3 billionaires in Europe with his chartered accountancy. One of them said, hey, there's this thing coming through, you should get a bit of it. He became obsessed with it. Now, he also taught himself how to code years and years and years ago. When we were driving down the coast, he's like, check out my spreadsheet. His spreadsheet is getting over 100,000 variations a day on if backdating Bitcoin from inception to now and looking at different trading philosophies throughout different stages of the cycle and what $1 would have become based on backdating everything that's ever worked in it. And then it's summarizing that into do this today.
Wow.
And that's 100,000 piece, like different trades
Every
a day
day.
that it's spitting out into this thing for him, and then it's summarizing it. It's like
That is obsessed.
it was difficult to do property well until I learned that it's really just about long-term cycles versus 10-year averages versus short-term returns, and that certain markets outperform others significantly. It is, once you've got the rules in place and then once you've got a way to automate monster amounts of data collection, the decisions that you can make are exponentially better. And so I suppose you either want to be one of those people that's obsessed, or you want to be deeply connected through particularly these scarier phases of cycles with people who are obsessed.
Well, because these are the best opportunities. So the last week in December, Ben and my colleague Tim sat down and, you know, used one of the online platforms called Hashtag, and they go back to 2007. So it gives us, 18 years worth of information and data for basically every single suburb around Australia.
So back to 2007. So it's got all of the last GFC in this data.
And then we do have the article from CoreLogic that looks at 30 years, so 1992 through to 2022. However, when we're talking to the guys at Hashtag, their belief is that some of the data in the early 2000s and the 90s is, you know, kind of a little bit muddled and hard to trust. So, you know, looking at the last 18 years gives you a really good snapshot. And the good thing is like, it's a perfect year for us. Like 2007 was sort of the mania phase, was kind of getting very close to the summit of the GFC. So it's ideal timing to have that final winner's curse, then having the crash and the rescue, and then obviously this full cycle that we're watching now. So what did you guys find? Like, this stuff, when I came into the office and you guys put this on my desk in front of me, I'm just like, Christmas came early.
This is the deepest piece of information that we've ever done. We'll talk about this more and more over the course of this year. Mainly, most of this will be kept for our clients because the advantage, once you understand how to read this data, is insane. But if we look at the last 30 years, right, I look at big picture trends first. We've always heard from CoreLogic that buying houses instead of units is an investment strategy because I think, what period did that data run up to?
92 to 22.
Yeah, so 92 to 22, we saw houses do, give or take, about 125% better across the country than units.
It was far more than that in your smaller cities. So like Sydney and Melbourne, it was around about the 120, 130% difference between houses versus units. But when you started to look into Brisbane, Perth, Adelaide, Hobart, Darwin, you know, it was a lot worse than that. And so...
Like you're saying even more than 125%?
A lot more than 125%. A lot more.
Then we also know from that same data set, finishing at 2022, that the metro markets on average, like the 8 markets, versus versus all of the collection of regional markets across the country did better by about 125%-ish.
Yeah.
But then when you consider the major metro versus the major regional markets, they were very, very equal. So I just want that to be clear. Like, it's a major metro, major regional market approach of houses that have historically performed better.
And just for context, like, major metro is basically every single capital city in Australia outside of Darwin. And then major regional is almost every single regional market with over 100,000, maybe 150,000 people that live there.
Yeah. So in the 30 years finishing in 2022, Sydney houses prices went up 507%, and Melbourne was the top performing market at 519%. Brisbane did 389%, Perth did 324%, Adelaide did 370%, Hobart kicked ass, actually it did 423%, Canberra did 430%. So effectively, it's exactly what we would have thought. Melbourne and Sydney, Brisbane, Adelaide,
Hobart,
Canberra, Perth. That's cool. We know that Australian property long term, because we've seen our parents and grandparents do it, has worked as an asset class.
And we know Melbourne and Sydney outperform everywhere else.
Simon Presley put out an incredible article last year looking at property data over a 50-year period. And one of the key parts of that article was Australian residential property has consistently been one of the top performing assets in the world in the last 50 years, averaging 8.2% countrywide. So just as we move forward, there's a history of confidence, which is important. Plus 70% of the market historically is mums and dads looking to own that aren't investing. Then if we go to the last 18 years, this is where it starts getting interesting. Sydney in the last 18 years did 267% growth. So from the last GFC till now,
everyone won.
Phenomenal returns. Give it to me, please. Melbourne did 215. Brisbane did 235. Perth did 117. Adelaide 220. Hobart, blah, 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 blah. They all kicked ass.
Yeah.
There's not a single market here outside of Perth that didn't do 150% plus.
Yeah.
Now, that's all well and good, but this is what starts to get interesting to me, right? We know the long term is good. Every Australian already knows that. How I start to see the market is very differently. It's like, okay, if everything kicked ass long term, give or take, what has kicked ass in the last 10 years and what hasn't?
Mm-hmm.
So Sydney in the last 10 years has done 71%. Melbourne's done 58%.
Wow.
Brisbane's done 126%. Perth's done 82%. Adelaide 114%. Tassie, ACT 80 to 100%. But effectively what that's saying to me is that certain markets here, for example, Brisbane doing 126%, has done 70% better than Melbourne
Over the same period of time.
In the same period of time. That's
And
important.
If we look at, 2007, obviously through to 2018 was when the vast majority of that growth occurred. Because if you look at the 18 year for Melbourne was 15%. 215, but if you look at the last 8 years of that, it was less than 30%, right? So between essentially 2007 and 2017-18, the vast majority of that growth occurred. And then if you look at from 2017-18 up until now, the last 8 years, you'll see the Brisbane data. Brisbane has actually kicked ass, and it's interesting to see that these two markets are almost on completely separate cycles.
That's so important what you just said, Simon. So 30 year, 18 year, 10 year, cool. I've got the story. This is where it gets really interesting. In the last 7 years, Sydney 61%, Melbourne 25% growth. Brisbane 102, Perth 100, Adelaide 100, etc., etc.
Playing devil's advocate, but Ben, those numbers in Melbourne over the last 10 years and 7 years seem horrible. Why would I invest there when I can go to Brisbane and get over 100%?
Exactly. So in Money Master the Game by Tony Robbins up there, he talks about the biases that we have as investors. And then you overlay the fact that Aussies more than any country in the world will back a winner. they back an underdog as gamblers. They do not back an underdog as investors. This is your advantage this year. If you know that Melbourne has done 519% in the 30 years finishing in 2022, did 215% since 2007, but in the last 7 or 8 years it's done 25%, and there's 160,000 people a year moving there, and the incomes are as high as anywhere in Australia, and the vacancy rates are low, and that economy on its own is fucked, but luckily it's not on its own. It's getting bailed out by WA and Queensland right now with all the commodities, and at some point it will sort itself out.
I was actually reading an article that was indicating, yes, it's been in a huge budget deficit, and that's why they've made some of these decisions to tax wealthy people and investors. And the expectation was for them to be in a budget surplus in the 28-29 financial year.
28-29
financial
wow,
year.
So they're heading
2-3
back.
Years from now.
Yeah, well, they're pulling a lot of money out of the property industry, I'll tell you that. Like, stamp duty is 25% higher down there. Land tax starts from $0.
It's working.
That sounds scary and crazy, right? Until one of our team members had a look at a 750k property purchase in Brisbane versus Melbourne versus Sydney versus everywhere. And we found the difference in holding costs over a whole year between Brisbane and Melbourne at 750k was under $500 a year when you factor everything in, because they don't have extreme weather events like we do here and in WA. So their insurances are less. Instead of charging 8% for management, it's 5 to 6%. Instead of this stuff, you know, honestly, this is the first time we've really gone deep into it for non-paying clients. But like that's one row. Like, that's one row out of a lot here. Like, I can confidently say the reason why we're not pulling out of the market is because 2007 to 2012, Melbourne was the top performing market in Australia. It did returns that you can't even imagine on leverage during a GFC. Why? If I didn't have this data, I'd go, why? Now that I have this data, it's because the performance in the 7 to 8 years before it, when everyone was looking at Adelaide, Perth, Hobart, Darwin, Brisbane, and Perth, people chose the winner. And because Brisbane, Perth, Adelaide, and Darwin kicked ass in 2025, 98% of Australian investors will go straight to those markets. Now, we love them. Don't get me wrong.
And they'll have a great year or two.
Maybe longer. Maybe Brisbane will have a phenomenal run up to the Olympics.
Some people are saying, you know, Perth could crank for the next 5.
But what I'm investing for is the next 10. And what I'm looking to do in the next 10 is double my money. And I'm trying to give myself an outweighted opportunity to do that. Now, according to the Australian Financial Review, and I'm not saying I'm only pro Melbourne, because we are licensed in New South Wales, Victoria, Queensland. We can help people buy Sydney, Central Coast, Newcastle, Wollongong. We can help you buy Melbourne, Geelong, Bendigo, Ballarat, Mornington Peninsula. We can help you buy Sunny Coast, Toowoomba, Gold Coast, and Brizzy. We love all of these markets equally for a long-term investor. But for our 30 to 40-year-old and 50-year-old clients that we work with, or investors like you, the next 10 years or 15 years matter. Why work for 30 years if you can get free in 15? And using this data, and then this is nothing compared to like the 60,000 data points that we get a day. This is just like, okay, here's the guide. That's the water finder. But we don't want water, we want to strike gold.
Well, you look at Melbourne, right? There's over 1,000 suburbs that make up Melbourne. So it's like, not all are considered equal. Like, you look at some suburbs, they went down by 5-6% last year in Melbourne, then other suburbs went up 20 to 30%.
So imagine you're an investor, and sorry to interrupt there.
No.
And you go, okay, I've looked at every market in Australia with 100,000 people, and I know the one.
Yeah.
Then within that market, it's not Melbourne, but let's just call it Melbourne, there are 1,000 suburbs, and we review the 1,000 suburbs across 15 key performance indicators each. So 15,000 indicators a day we look at. Now, it isn't always updating because I don't always press refresh on the button, but any day
It's
that
property,
we
it's not going to change overnight.
we can change it once a month and know what's going on.
That's it, once a quarter.
So then you go Melbourne, and then you go, there's 7 Melbournes, 7 parts of Melbourne. this is the most undervalued. And not only is it the most undervalued now, but it's the area that did the most growth in the last GFC between 2007 and 2012. And then within that, that's a collection of 80 suburbs. Let's review them. Let's nail this one suburb. Now, within that one suburb, there is 1,000 sales a year. Let's rule out 990 of them and pick these 10. And then of these 10, let's pick this one for this reason. It's
That's
like
obsession.
That is how you beat market averages. And
Yep.
that's why our average clients have fucking made bank.
It helps you sleep at night as well, because you know that you've dotted your I's and you've crossed your T's and you've eliminated all potential opportunities to just focus in on what is going to be the next thing.
But that also doesn't mean that in the next GFC that you're not going to take a bath for a couple of years, and you're not going to be scared holding it, and you're not going to question, did you make the right decision or not? And you're not going to go, shit, I should have bought Perth because it did 16% this year according to SQM, and Melbourne did 3%. But if you can go up a level from like short-term thinking to investment-based decisions. Now, people use data for stocks. Why wouldn't you use it for property? Like, just because you can buy it yourself doesn't mean that you shouldn't use world-class data and AI and coding and the smartest people to pull that information together. And so when I think about where we are, it's no doubt scary. If this was the first time I was hearing it, I'd be like, if that was the first time I was reading it, it scared the shit out of me to the point where I'd bought like 9 properties and sold down to 2. When I first read the book, I went, oh my gosh, I don't know what I don't know. My natural tendency is to put my head in the sand and be scared of everything. But as my knowledge has grown, as I've had direct access to some of the greatest minds in the world, like literally, that are still alive, and read the books and listened to them and read everything they've done and listened to their videos, and then started to use like the AI/coding integration to make decisions. I just went and spent 1.2 million bucks buying a 4,000 square meter piece of land with a beautiful house on it, walking to the beach in Geelong. Like, that could be rezoned for like 15 to 22 townhouses. Like you were looking at houses. We missed one at auction recently. A house walking to the beach in Geelong for 535,000 bucks. You were looking at houses on the Mornington Peninsula and in northwest and west Melbourne
For less than
700k. Those houses in Sydney would be worth 1.2 mil, 1.5 mil, 1.8 mil.
To dive just a little bit deeper before we finish up, is another bias that people have is like a location bias. You know, a lot of Australians have been really fortunate to grow up in lovely neighbourhoods with, you know, great families, middle class or above. And so they have this tendency towards quality, blue chip. So did we.
So do I.
So do we.
Do I.
There's a lot to that as well. But when we, you know, just separated all of those biases and emotions and focused on the data, the best performing markets were the shittest. Like the lower socioeconomic areas and the ones that have the high percentage of renters, the higher vacancy rates, the new house and land estates, the lowest incomes.
Hectic to find that in December.
And it just is mind-blowing to think. So it just like basically counteracts everything that people believe. It's like, no, Bondi is better than Blacktown. According to the data, it's not.
So what we did here, like in the back end of this, like you don't know how painful this was to pull together. Like fucking
Get out of it. You love it. You love it.
Yeah, I love that. Like Tim loves it. But
Excuse me.
You know, let's say that Sydney's 1,200 suburbs, 1,000 suburbs, whatever it is. Not only can you look at like 18-year, you can look at every year, but you can start to see, like, I'm looking at Rose Bay, Vaucluse, Manly, Cronulla Beach versus Liverpool, Penrith, Blacktown, Parramatta. And you can see what they did individually year on year. You can see what they did collectively. You can see what their local government area did. And it makes sense, right? Like, if Australia is as cool as Australia thinks it is, and
I think it is.
Sydney and Melbourne, I agree. Sydney and Melbourne have investors from all over the world that want a piece of the pie. Then those prices, like they have in all of the other big cities around the world, can like 10x from where they are right now. But some of these suburbs closer to the city are driven by locals. And when locals get priced out from spending any more, Like, what was crazy to see, some of these suburbs in Melbourne and Sydney and Brisbane that are the most expensive have literally done 25% since the start of the last GFC till now. And the Ipswiches, the
Yeah.
Logans, the North Perths, the shittest places in South Australia near Adelaide or Brisbane or wherever have performed at 200, 300, 400%.
And I think an opinion that I have in relation to this is like you look at those high quality, top end blue chip suburbs, the percentage of owner occupiers is enormous. You know, we're talking 80, 90+% owner occupiers. So there isn't many investors that are playing in that world.
Can't
And so
afford to.
there's just not as much demand. And so it does mean that like one sale can dramatically affect the growth rates. And so it's hard to get a bit of a real snapshot on it versus these entry level suburbs. You may see 40% renters to 60% owner occupiers. There's more demand there from the investment world. And we've seen the share of investment go from 20 to 25 to 30 to 35 to 40. Now on our latest monthly market update, it was 42% of properties being
Wow,
purchased
that's
by
a
investors.
big deal.
You look at the percentage of institutional investors, so think real estate investment trusts, super funds, etc., that are getting into the real estate market. It's gone from low single digits to 5. Now it's at sort of 10% of property purchases by institutional investors now. So these guys are only making decision based on data, based on logic, based on history, and they're looking for those needles in the haystacks, and they know how to find them because they've got access to similar information that we do. And so that's, you know, you've got more demand there, and because of that additional demand, you're seeing more transactions, you're getting more information, more data points that's helping you make these better decisions as well. So it just helps to, you know, have a look at yourself and think about those biases that we all have, the recency bias, the location bias, you know, the comfort bias. I'm not too sure what that one's called. But, you know, you've got to just look yourself in the mirror and just have an honest conversation with yourself and go like, am I making this decision with my heart or am I making it with my head? And am I basing these decisions off the information that, you know, has proven to work time and time again, or because it makes me feel good inside?
It's really cool. Like, I've loved this journey with Phil and Akil. I'm so grateful for what those guys have given to me, my family, my friends, our clients, and you guys as well. Their information has completely changed the game for us. Their ideas, they made me realize more than anything else that I'm not crazy. Like, I thought I was the crazy, and I am. Like, I'm fucking mad about this stuff. But I don't feel as lonely when there's people out there just as obsessive about like learning how to do this well. Like, we live once. We get this opportunity to invest. And for most of us, we're not going to go on to 10, 20, 30, 50, 100 properties like everyone on YouTube. We want a small dose of incredible properties to make retirement fantastic, to be able to have choices and freedom and live the life of our dreams now. Not when we're 60 or 70, like now. We want to do work we enjoy. We want to spend time with our kids. We want to travel. We want to train. If you're into spirituality, like, you want to be as close to the source as you possibly can. Like, you want the opportunity to become the best version of yourself in 2026 and for every single year from here on out. And we hope that some of these ideas from these geniuses that are so many notches up the thing compared to like where we're coming from, it's not even funny. But if we can learn from these guys and we can make better decisions from these guys, then we can help our families, which is ultimately what it's all about, win. And we can be more generous and we can be more kind and we can give more to charity or to church or to whatever is meaningful for you. Like, imagine you could buy a property or you could pay off a property for every one of your kids. Imagine if you're doing really well and you can pay off all of your brothers and sisters' homes. Or imagine at Christmas, you don't have to think about it. Or next time you want to travel somewhere, it's just like, yes. Or in retirement, you can be in that incredible place that you really want to be because you've done the heavy work now. Now, like you said, it is scary. There's biases. It's hard. You got no idea how many times Simon and I have hit rock bottom or cried or been pushed so far beyond our boundaries to do what we've done here. But a full cycle in, I'm so grateful that I've gone through it and I've learned and I've grown and I've confronted myself and I've run away from myself and I've frozen and I've gone through all the feels, because it can be learnt. And you can use this information to completely change your life and every single person's life that you care about. And that's what this is ultimately about. It's not a book. It's not about investing. It's about getting financially free and becoming who you're supposed to be sooner. So I love this stuff, man.
I love
that
it, man.
was awesome, bro. Yeah, you're a bit sick at the moment. But yeah, thank you so much, Phil, Akil. If you guys haven't already done so, please buy their books. Please check out their stuff. I promise you it will completely change your life as an investor forever. G'day guys, my name's Ben and I'm the director here at Pumped on Property, and I just want to say a massive thank you for watching our content today. Now, if you're thinking about buying an investment property in the next 3 to 12 months, then the team and I would love to offer you a one-on-one strategy session. In that session, we can talk about exactly where you are right now, where you'd like to be longer term, and we can deeply educate you on the Australian market. And then you can take that information and go and absolutely smash it on your own, or potentially become one of the small number of clients that we work with each week. To book your session, all you have to do is go to www.pumpedonproperty.com and click that book your free strategy session button. But either way, we wish you all the best on your journey as an investor to financial freedom.